Welcome back to QAV, episode 845. We're recording this on the 10th of November, 2025. Keeping with the 25s, the last time our guest was on this show was episode 525, 300 episodes ago, I guess. That was in July of 2022. Welcome back, Michael Goldberg from Collins Street Asset Management. How have the last three and the change years been for you and Collins Street, Michael?
Brendan and Tony, thank you for having me back again. It's always a blast to talk to you guys. The last 3 years has been an interesting time. I mean, certainly I think value investing struggled for a little while. We've been able to put together some really good returns. I think we're still running at about 14% since we launched in 2016. The last 5 years, I think we're running at about 14.5%. So no complaints there, but it's certainly been a bumpy ride. And I think anyone who's a value investor would probably say the same. How have you guys done in your investment last couple of years?
We had no, but 2021 to 2023, the couple of years there, were tough. We really suffered and we thought it was just us. So I'm glad we should have had you on more often during that period so we could commiserate.
I know you guys are much more data driven. I think you guys probably have more sophisticated tools for picking your stocks. But for me, it's been interesting and frustrating in equal parts. Ordinarily, look, again, over the last year, it's been really, really good for us. But the couple of years before that, it was surprising how many stocks stayed in our portfolio for a long period of time. Normally you have some sort of recycling going through, but I just found that the last 4 or 5 years, the stocks that were cheap 5 years ago were still cheap a year ago. And that's a strange and different sort of situation to be in. But our take is if they're fundamentally good businesses, eventually the market will cotton on. The question is, when's the eventually?
Well, I was just going to say our portfolio, the one that we run for the podcast that's been running since 2019 now, I guess. Last 5 years, it's just a little bit less than 19% per annum.
Amazing.
But nearly half of that is dividends, right? So 11.5% is capital return, the rest is dividends. But that couple of years I mentioned, like just COVID, post-COVID was great, 2020 to 2021, middle of that. As soon as interest rates started to go up, it was basically beginning of 2022, interest rates started going up, Ukraine happened, and it was a rough couple of years. But last year or so, it's been great. Again, last 18 months, it's really recovered quite well. Some of the portfolios that I started for our program we started called QAV Light in early 2022 were underwater for like a year and a half, 2 years. It was miserable, and they're all doing double market now. So
if you didn't,
the last 6 months have boomed through.
I think if you didn't own Commonwealth Bank over the last over those couple of years, you were pretty much out of luck.
So, Michael, it's been a couple of years, as I mentioned, since we had you on, and we keep saying we should get Michael back on, but we were too miserable. Then I got your newsletter, or Rob's newsletter that came out, your September 2025 quarterly report. And I know you mentioned artificial intelligence, and I know Tony's got a lot of questions for you, which we'll get to in a second. But before we get to that, you highlighted 3 companies: Astron Limited, Seven West Media, and Hum Group Limited. We're quite familiar with and Seven West Media. Got a question for you about them in a minute, but Astron hasn't been on our buy list. But the last time you were on our show in 2022, you mentioned Astron, ATR. I think they might have been a new investment for you.
That may be.
Then, Can you remind our audience about Astron, who they are and what they do? They're a mining company, aren't they?
They are. They're based out of an area called Donald, which is in country Victoria. They own probably the world's largest undeveloped mineral sands mine, and they also have rare earths on that same tenement. In terms of their progression, the recent negotiations with the US have seen them get some very attractive funding from the US. And I would say in the last 12 months or so, the stock has probably gone up about 150%. They've actually had a split, which means that if you look at the share price, you might not be able to tell that. But yeah, I mean, if they manage to get their mines up, their mineral sands project alone is big enough to last for about 40 years. And they could produce as much as, I think, 10 years of global demand by themselves once they get it up. So it's quite a large mine. It's got quite a lot of upside potential. And like I
Wow.
said, they've now got a US partner. They've now got financing, and so it looks like they're moving towards getting beyond just the theoretical decision making and potentially into, finally, after almost a generation, developing the mine site, which would be very exciting.
When you're assessing a company like that, do you follow or take a position on the underlying commodity? Do you work out, is that in the doldrums? Is it doing well? Which I guess for mineral sands would be something like titanium dioxide.
Look, the mineral sands are the sort of mineral sands that go into building tiles. It's not as exciting as perhaps some of the higher tech mineral sands or rare earths. Most of their mineral sands that they have mined historically, they had previous mines, have been sold into the Chinese market, literally to make tiles or what would you call, like porcelain goods, the sort of things that go into making bathtubs and kitchens, are what you'd use this brand or this version of mineral sands for.
Right.
The rare earths, so you're right. The rare earths are much more exciting, but that's not what they've focused on until now.
But do you do any sort of analysis on the underlying commodity? Because, for example, lithium stocks a few years ago were a huge boom and bust cycle, and you kind of could see that coming and going in the commodity itself before you worried about the miners who are mining it. So do you take a position on whether your company is going to do well because the market for the underlying commodity is strong or weak, or where does that fit in?
I think that if a commodity is doing exceptionally well, you do have to take a position, because otherwise it becomes difficult to work out what the value is. For something as boring as mineral sands, I don't think it's as necessary. The mineral sands price has been pretty flat for an extended period of time. They did a feasibility study 15 years ago, and they did another feasibility study again a couple of years ago, and both times it showed, based on prevailing prices, that they are very, very economic. And so there we didn't have to take a strong position on what we thought mineral sands was going to do. But to your point, we were asked on several occasions if we were investing in lithium when the boom kicked off, and our take was, look, there are certainly companies that are going to make fabulous money out of it, but at this point, we don't know. We can't work out based on our assessment of demand and supply and what's coming on in terms of production whether lithium is expensive or whether it's cheap. But certainly, it's much more expensive than it was yesterday and the day before. So I think if you're investing in something that's going through a boom, you have to have a strong position on what you think the genuine value of that commodity is. But if you're buying something that hasn't experienced a boom like that, and you can assess the project based on its economics, then I think it's less important.
And you do, your company does take positions on commodity related themes too, because I've seen special funds set up to take advantage of that.
Yeah, absolutely. I mean, probably our most famous or infamous special situation fund is our gold fund. We launched it about 2 years ago. And even then, at the time when we launched it, Vas, my business partner, and I, we didn't agree on everything, which is not a surprise for anybody who's met me and Vas. But, basically, Vas was very, very confident that the price of gold was going to increase substantially from about the $1,600 at the time. I'm dobbing myself in here. I said, I understand all the reasons for why you think the tailwinds stack up. I understand demand and supply. I understand there's been an under development of new projects. I understand, that if you look at gold as money, then if you're comparing it relative to regular currencies, that there's a lot of upside just based on the inflationary impact. But I said, I'm not comfortable investing in gold stocks based on speculation. I want to be sure that if we're buying gold stocks to get exposure to the gold story, we're buying gold stocks that are cheap based on the current status quo. And so that's what we did. We looked for companies that were priced as if gold were, at the time, I don't know, $800 or $1,000. And we said, you know what, whether gold goes up or a little bit down, these companies ought to do quite well. Now, of course, we've had the double tailwind that gold prices have gone up. And a lot of these companies, not all of these companies, but a lot of companies have seen a lot of excitement come into them. And so I think we've seen about 150% return in about the 2 years that we've been launching since we've launched the fund. But yeah, they're certainly helpful to have a view on the commodity. But my preference is to not be reliant on higher prices for the commodity to make money out of the equity investments.
I don't take special situations in the way you just described it, but what I find is that by following our process, you look back and say, gee, I bought a lot of gold miners in the last 6 months, and it becomes a theme anyway from the ground up rather than identifying the macro factors involved.
You know what? I agree, Tony. I mean, that's how this actual fund came about. We're not out there looking to launch new funds. Vas and I are investors. We love businesses, we love valuations, we love finding opportunities. And when we find an idea through our broader research that either doesn't fit mandate or goes a bit too far for our flagship fund, then we'll launch something to give us, special exposure. So we've got a little bit less now, but at the time when we launched the gold fund, we already had 30-ish% exposure to gold companies in our flagship company.
Right.
But we both wanted more, but we didn't think it was appropriate to have more than 30%
Right.
in what's supposed to be a diversified portfolio. And so at that point, we said, well, why don't we just launch a new fund? We flagged the idea with some investors and they were all on board. And so we launched it, and thank God we've done very well.
And is that, and I think the other thing about the special situation funds, which I find interesting, is you're not intending to keep that open forever. It's going to have a life cycle and end at some stage.
Yeah. So the way we structure them is that number one, they've got a life cycle, they've got a maturity date, and number two, they're closed. And we do that for two reasons. Number one, I think investors in general tend to stress when they see volatility. And if you're investing in a single commodity, good chance you're going to see some volatility. So if we give ourselves a 3 or 4 year time horizon, we can see our way through that volatility and get towards the positive outcomes. And so that's why it's a closed-ended fund. And in terms of timeframes, if you're investing in a single type of idea, there's no single idea that I'm aware of in the history of the world that has been value forever. Things become cheap and things become expensive, and at some point you're going to want to exit. So we think that, for these sorts of things, for these sorts of cyclical thematics, 4-ish years is probably about right. That gives you enough time to see the results. And then if people want to stick around afterwards, they're welcome to stick around afterwards. If people want to get out, then we give them the opportunity to get out.
So the fund might keep going, but you allow redemptions after a certain date. Is that how it works?
Yeah, that's the way it works. We also, often with these sorts of things, will have like capital returns along the journey. So again, we launched this particular fund, the gold fund, about 2 years ago with the intent it should last about 4 years. We've seen, like I said, some spectacular returns in the first couple of years. And so we actually returned about 78 cents on every dollar that people had already invested, that people originally invested. Wow. We returned back to clients a couple of months ago. So they've still got, I don't know, $1.50, $1.70. I think it's probably $1.70, $1.75 for every dollar they invested. And they've also got 78 cents back. So
that's like a PE of 1.3.
So yeah, look, I mean, I think people like getting their capital back. I think it improves your IRRs. And if people want to reinvest it, then we gave that opportunity to people who did want to reinvest. But we thought, given that people had come into this fund with an idea of how much risk they wanted to take, given that they've now got much more exposure because the fund had done so well, we gave people the opportunity to take that off the table.
So given you watch the sector quite closely because of that fund, what's your view on the life cycle of gold? When do you start exiting positions yourself?
Tough questions, Tony. Look, I mean, you can pick arbitrary numbers. You can say, if the portfolio goes up more than X%, or you can pick an arbitrary number in terms of what gold prices are in a particular currency. There's as much art as there is science. I think, in my view at least, I think the point at which I'll get genuinely concerned that we've hit the peak of the cycle is the point at which listed companies are predicting higher gold prices in their valuation. So at the moment, granted that gold prices hit 4,000, I think if you look across most of the gold stocks on the ASX, most of them, their earnings or the unit price is predicting gold price well below 3,000. I think that's probably quite usual for when a commodity is becoming hot. I think when a commodity has become hot and perhaps too hot, you'll start to see the market predicting $5,000 gold price when the gold price is 4,000. And at that point, I'd be very, very concerned, but I don't think that we're there yet.
I've noticed a couple of miners, I can't recall which ones, so possibly not ones that I own, they've started to go unhedged, which is kind of like what you're saying. They're saying, we think the gold price is going higher.
Yeah. I think we've seen that probably for a couple of years. Look, it's hard to know. You can say either they are insiders who know the market better than everybody else, and so we should listen to them, or you can say they're insiders, and insiders often make terrible decisions at peaks and troughs, and so we shouldn't listen to them. It's take your pick.
Okay.
Don't get high on your own supply, as Scarface said, or somebody
Maybe.
said in Scarface. Yeah.
And speaking of situations, your latest quarterly report went into AI in depth. So And I guess from a value perspective, what are your takes on the whole AI bubble, circular economy, or next horizon for mankind that's going on at the moment?
Look, I think that AI is a fascinating conversation. But I think that people get carried away a little bit when they start talking about it as if AI was actually artificial intelligence rather than just a tool that is really good at collating, reading, assessing data, recognizing patterns, and then feeding you back best practices or consensus feedback. I think that, what's his name? Sundar Pichai, CEO of Google, said that he thinks that AI will be as revolutionary as fire and electricity. I think it's probably right. I forget who I saw it sourced from, but I recall reading somewhere that they were comparing AI to oil. They were saying AI is the new oil. Not that it by itself necessarily. I mean, it by itself will add tremendous value, but where we'll add the most value is how it drives new economies, how it drives new outcomes, how it drives new efficiencies. And so what comes out of AI is, I think, going to be much more interesting from an investment perspective and from a well-being perspective and from a humanity perspective than the AI by itself, which at the moment I think is really just a really, really good algorithm. That might be a bit simple, but that's where I see it at the moment.
What's your take on the fact that every time I open an annual report this year, it's got AI somewhere in the paragraphs? I mean, are we too early to see any sort of benefits in the general run-of-the-mill company, or is it coming, or what's your take on that?
Look, I think it's certainly coming, and Cameron, I think you mentioned that we wrote about some of the companies in our quarterly report. Seven West, obviously the media space, they would be crazy not to use all of the data they've been collating through their online offerings to better target advertisement. Now, again, in the olden days, you might have said that was an algorithm. Nowadays, you can use AI to grab such massive chunks of data that you can get better outcomes and better tailor make your targeted advertising. We mentioned in our quarterly report that we had some exposure to Sky Entertainment. So Sky Entertainment assesses gambler behavior to identify problem gambling so they can be in line with regulatory expectations and cut it off where necessary. I think that AI is going to play a part in everybody's life going forwards, and I think it's inevitable. I think it's inevitable in much the same way that the Industrial Revolution changed the way we went about our day-to-day lives. I think to some extent this will have a similar impact. Now that can be scary, certainly in some regards, but it can also be very exciting to think, what the world will look like going forwards, given these massive efficiencies and the ability to cheaply implement best practices for every mum and dad, shop on every corner. It's a fabulous, fabulous tool if used properly. And I think we'll have to use it properly if you want to keep up.
Are you therefore ascribing an extra value to Seven West Media or Sky Entertainment because they've got the ability to use data, or where does it fit into your valuation model?
There's no specific part of our valuation model that relies on or has an expectation that AI should play a part. That being said, I think that any company that does not implement AI in some way in their business model, they're going to be left behind. I suppose your question is, if it's adding efficiencies, can we predict better earnings going forward than what we've seen in the past? I don't know. I don't know, because I suspect that if you're doing it, if you're trying to drive efficiencies, but all of your competitors are also trying to drive efficiencies, it may be a net zero sum game.
Or a cost.
Or potentially a cost. Again, I don't know that AI is that expensive. I think a lot of these companies are already paying for data. And I'm not sure that AI is necessarily going to add a substantial cost in the long run. In the early period, perhaps now, it will add value at a cost. At some point, I think it'll be widgetized or commoditized, so that it's expected that everybody should use it, and it probably won't add a tremendous amount of value. I mean, it's really the same thing with the NVIDIAs of the world, the NVIDIAs and the Oracles and the Snowflakes, and locally you've got companies like NextDC and Ape, and all of those guys have quite by accident benefited tremendously from the ramp up of AI. And they've definitely got a first mover advantage. But at some point, even amongst the AI providers, if you look at ChatGPT, or you look at Perplexity, or you look at any of the other ones, they might have a first mover advantage, but eventually it feels to me like it's going to become somewhat commoditized. So yes, definitely first mover advantage. Yes, definitely if you're an early adopter, you've probably got some advantage, but eventually I think it'll become an expectation.
It's like a hygiene factor for just being in business, really, isn't it?
Yeah, I think so. And you'd be mad not to try and take advantage.
Yeah, sure. So, you mentioned sort of unintended consequences or secondary consequences there. What about on the economic side? Are you envisaging any sort of dislocation because of unemployment, for example, when AI becomes widespread?
That's a good question, Tony. And we were actually talking about it at lunch on Friday. We had in our office, we have lunch together every Friday, and we talk about, the rule is no work talk, but sometimes we get into tangential work-related stuff, and we were talking about AI this past week. And I think the challenge anytime you're experiencing change is it's very, very easy to recognize and identify what the cost is and what you're going to lose. It's very, very hard to identify what the benefits are going to be. And I found myself thinking, if we compare ourselves to, my grandparents' era, the era that came out of World War II and set up and rebuilt their lives here. And I think of my grandparents and wonder, what would my grandmother have thought when she worked in what we would call today a sweatshop, doing sewing for locally made, dresses and jumpers and whatever it was. What would she have thought at the time when we experienced some serious globalization and those sorts of roles went overseas? She would have probably been frightened out of her mind and, concerned for what the future would look like. But if you fast forward now with the benefit of hindsight, the way that our grandparents and our great-grandparents lived compared to where we are today, it's incomparable. It's incomparable how much better off we are today, even given all of that change. And I think we'll probably find the same thing, I think we'll find that it's scary to make a transition. I'm sure the people who made saddles for horses, and I'm sure the people who are the town expert at building horse-drawn carriages were very, very frightened when cars came about, when the combustion engine was used in automobiles. But I think if you look at the wider world, no one's going to argue that we aren't better off. And I think the same will probably happen with AI. Will there be some turbulence while we go through that teething period? I have no doubt. What that will look like, I have no clue. But I'm sure that when we get to the other side, with the efficiencies that this sort of data assessing tool can do, I think we'll all be better off for it. Hope.
So do you
either
see
that
AI
or the machines will control the world.
Yeah. So do you see AI as kind of like just a fifth gear on current data usage, or do you see it as being, the super intelligence that just blasts our ability to do things ourselves out of the water?
So I don't know if I don't know enough to not know, but my understanding of AI is that it consumes a tremendous amount of data and that it finds patterns. So for example, when you go shopping on Amazon and you buy meat pies, down the bottom it will say people who bought meat pies also bought sausage rolls and tomato sauce. Now the AI might not know why you'd buy tomato sauce with your meat pie, but it recognizes the pattern and it calls it out. Right? AI, as far as I understand, doesn't create anything new. So for example, if you asked AI, back to my analogy about horse-drawn carts, if you asked AI back in the day, how do I improve my manufacturing of horse-drawn carts, it would give you best practices for how to make and sell horse-drawn carts. It would not suggest that you invent the combustion engine and implement it into a car. If in the 1990s, I think it was 1990s, if you asked AI to help you build a better phone, it would have built you a Nokia that was indestructible and waterproof and would never break, and perhaps a better battery. It would not have created for you a BlackBerry or ultimately an iPhone. So I think it's important to recognize that while AI, at the moment at least, mimics human behavior very, very well, it's not actually creative. I was talking about, again, Friday lunchtime, we were talking about mimicking, when mimicking looks like reality. And Andrew, who you met earlier, who's a bigger music aficionado, he said, Michael, do you remember the band Roxette from the 1980s, 1990s? Yeah. Joyride, Dangerous. I enjoyed it as a youngster. He said he read somewhere in an article that at the time they were recording their early albums, they didn't actually speak English. And so instead they would transliterate their songs into Swedish, and they would sing it in Swedish with the words coming out being English words. And that's a bit like how I imagine AI. AI might sound intelligent. AI might be able to produce things that seem intelligent, but ultimately it's transliterating. Ultimately, it doesn't really understand what it's saying. It's just identifying patterns and sharing them back with us. And again, pattern recognition is fabulous and important and adds a tremendous amount of value, but it's important to distinguish between pattern recognition and creativity. I think certainly in my understanding of where AI is at the moment, it's not creating, it's just recognizing.
Yeah, interesting. We could probably talk for hours on the philosophy of all this.
I'm deliberately not entering this conversation.
Wonder whether to invite you in. I'm just going to ask one more question, and I can invite you in, Cam. Just to get back to markets, Cam, I don't know if we recorded those stats you had before about the growth of the US market and how much was attributed to AI, but a large amount of the growth in the US market is attributed to AI. What do you think happens when that comes off its peak? Does it flow through to the Australian market? And do you foresee any positioning you might do to mitigate that when it happens?
I'm not sure, because is your question assuming that AI-related companies are expensive, what happens when they correct? Or are you asking about AI and its effect on broader markets?
No, the first one.
Yeah, look, I mean, there's no question that the Australian market is impacted by US markets. Even when we shouldn't be, we tend to be. And so if you see a big pullback in those stocks, especially the ones that are tangentially into AI, the Magnificent Seven, none of them are directly AI. In fact, I don't think there's an AI company that is a pure play AI company that's listed. But certainly they've gotten a lot of their growth and a lot of their hype off of jumping on the AI bandwagon. If they come back, it'll impact the broader US markets, and that'll certainly impact us as well. In terms of protecting ourselves from it, I don't know what you do except for invest in good quality companies that are absurdly cheap.
So you wouldn't, for example, start buying government bonds when you think things are very overvalued in the US?
Look, that's an easy question for me because that's outside of my mandate. People hire us to give them their equity exposure, and so that's what my focus is. I think that if we fled to government bonds every time something made us nervous, we launched this business in 2016. We would have been in government bonds since 2017 and missed out on fabulous returns since then. So I think you have to temper your expectations, and also you have to temper your concerns. I think things are never quite as good as they might seem at first, but things are also never quite as bad as they might seem at first.
No, fair enough. I agree. Cam, can I invite you in to talk about AI for a sec?
No, that's a really bad idea.
Okay.
We'll never get out of here if I do that. Well, I did have a question though. Talking about Seven West Media, a few weeks ago, Michael, we had Gabriel Radzyminski from Send on Capital on the show talking about the Seven West merger with SXL, which he is an activist against as an investor. He doesn't like the sound of it. As an investor in Seven West Media yourself, what do you think about the merger?
The only case I can make for it is that if Seven West can get the PE multiple through the merger, then it's worthwhile. But on the numbers, it seems to me that this should have been 60-40 in favor of Seven West at the least. But again, it doesn't matter what I think. It matters what's going to go ahead and what's going to happen. I think there are certainly synergies for a combined company, for sure. You take competitors out of the market, then you can improve your margins. I don't like it. I'm not sure there's a ton we can do about it. And I'm hopeful that we'll see a re-rating from Seven, which is currently trading on some ridiculous multiple, like 3.5, 4 times. So if all they get is a PE re-rating through the merger, then maybe it's worth it. But yeah, no, when I first saw the proposal, I was none too pleased, to be as diplomatic as I can possibly be.
Did you see, I think it was the Channel 9 results last week that came out and said their commercial TV revenue was down something like 18% for the last quarter, I think?
I didn't see that, but I did see Seven say that the market had softened.
Oh, it was Seven, was it? Okay. I could have that wrong, sorry.
No, it could be you're right. I saw the Seven. I saw an announcement from Seven, but it could be that you're right about 9 as well. We actually were wondering whether 9 would come in and eat Seven's lunch in terms of this merger here. And I don't know that I'd say we were hopeful that they would, but surprised that it hasn't happened yet, I suppose is fair.
Yeah, fair enough. Back onto the AI, I guess, and its effect on the market. As you know, we run a US show with its own portfolio that tracks our buys and sells, and it's doing at least market for a while there. It was doing 3 times the market without having any AI stocks in it and Mag 7 stocks in it. It seems to me that if all the money gravitates to the AI stocks, it does create value opportunities in some pretty good companies in the rest of the market. Are you starting to see that over there or even in Australia to a certain extent?
Yeah. Look, I'm not sure that we've seen it in Australia. I think Australia's been quite different in terms of how the market's behaved. I think in America, you have certainly seen that. You've seen the Magnificent Seven take a tremendous amount of attention and capital flows, and we have found that there is a massive pool of undervalued and, I suppose, under-researched stocks in the US and in the global markets. Our focus here is the Aussie markets, but as part of our research, we do look globally. And who knows, there's a decent chance at some point in the future we will launch a global fund as well. But I think I think you're right. I think it's undeniable that when you get a tremendous amount of hype in one particular sector, it sucks away capital from other sectors, and creates almost a two-pace market where all of a sudden you're being forced, if you want to get exposure to Nvidia, to pay 50 times earnings, whereas if you can identify a manufacturing company on single times multiples, and yet it can't find a bid in the broader market. So yes, I agree with you. I think we saw that to some extent. I think locally, with so much of the cash flows, the institutional cash flows going to companies like Commonwealth Bank for such a long time, and also the top 20 in general, that you've seen our small and mid-cap market completely ignored for a long, long time. I think that's slowly starting to reverse a little bit now. And I think you see the same thing in the US markets.
In the Australian sense, is that also exacerbated a bit because of index investing? So they're forced to buy CommBank, and the brokers or the fund managers who are covering small caps in particular have been hollowed out and just not there now.
So I'd like to say yes, Tony, but I don't think it's quite so simple. And the reason I say that is because if it was just index buying, you would see all of the top 10, which I think represent about 60% of the ASX 200, all moving up in tandem. And we didn't see that. BHP has been pretty much flat. CSL has done quite poorly. I'm not even sure if it's in the top 5 anymore. It's probably close. Whereas Commonwealth Bank were doing fabulously well. I think it's a combination of two things. I think it's number one, there's been a massive flow of passive investing through the ETFs, and I think that has impacted the top 20 for sure. But I think a company like Commonwealth Bank in particular is especially attractive for the institutions looking to park money where they need liquidity and they can feel safe having invested in what feels like a safe stock. So I think beyond just the index investing, I think Commonwealth Bank benefited from institutional flows looking for somewhere where they can get some liquidity in the Aussie markets.
Yeah, right. Cam, I think I've gone through my list of questions. Do you have anything to add for Michael?
No, I guess we've covered everything that I wanted to talk about. Just talking about the AI stuff, though, I did have a news item today. I have mentioned, I'm not sure if it was on our US show, but on one of my shows recently, that Jerome Powell, when he put out his latest jobs report, said that there's a big freeze on hiring in the US. They're calling it the Great Freeze. A lot of companies are just not hiring university graduates because they expect AI to be able to do their jobs in the next couple of years. And I just saw this morning the Department of Industry, Science and Resources reported that tech employment in Australia dropped by over 30,000 roles in FY25, reducing the tech workforce to 949,000, the first decline since 2020. And again, AI taking these jobs is the main reason that's being given. So, we have been waiting to see job losses credited to AI taking people's jobs. Haven't seen a lot of that in this country yet, but we are seeing companies saying, well, we're not going to bother hiring people because we assume that AI is going to be able to step in and fill that role. And I find it difficult. You were talking about saddle manufacturers and your grandmother And those jobs, for the last couple of years, I do a show called The Futuristic, where we look at all of this stuff. Each week we look at AI and robotics mostly. The challenge that I have when thinking about the next 10 years is trying to figure out what jobs will be available that AI and robots won't be able to do better than a human. I've spent a couple of years trying to figure that out because, in every tech revolution that we've had since the Industrial Revolution, the new technology has wiped out some jobs but replaced it with other jobs. But we're moving into this era where it's very hard to work out what the jobs are that aren't going to be able to be done better, faster, cheaper with the combination of AI and humanoid robots. So I am a little bit concerned about kids going to university right now, what the job market is going to look like for them when they get out in the next few years and the impact that's going to have on a whole generation of 18 to 23-year-olds.
Yeah, no, Cameron, I agree. I think it's going to be most tough for the junior workforce. I think people looking for the first job, even if I imagine in white collar roles like accountancy and in law, a lot of the jobs that you would give a first year uni, the sorts of jobs you, pardon me?
Oh, so coding, just tech jobs, obviously, is the first to go.
All the sorts of things.
Journalism.
All the sorts of things that you would get your junior, associate to run down information or look up case studies or run down some paperwork. All that sort of stuff is going to be managed by AI. Perhaps you'll need, one employee overseeing, an AI machine that can do the job of 5 or 10. I wonder how quickly it's going to impact established roles. I wonder how much value there is in creativity and recognizing outside of patterns. Again, I think AI is exceptional at identifying status quo and patterns and what works normally. I think there's still a space for humanity, hopefully, in identifying things that are outside of the norm, opportunities that stand out because they are not standard, and I think you'll find that in professional services there'll be a place for that sort of thinking for some time. But ultimately, as AI gets smarter and as its database grows, I think making a distinction between human enterprise and AI enterprise will become increasingly difficult. My worry or wonder is if AI is drawing from this massive data set we call the World Wide Web, which is essentially all of humanity's best efforts saved in the cloud. What happens at some point in the future where they're drawing from the data set that is majority AI created? Is it like the snake eating its own tail? Is it going to create all sorts of unintended consequences? I don't know, but that seems like a problem for another day.
They call it the dead internet theory. It's the internet is being produced by, it's already happening. Something like 50% of the content on the internet now has been produced by AI, not by humans. So we're already starting to see is it Ouroboros?
Ouroboros,
the snake?
yeah.
Ouroboros, the
Ouroboros
snake eating
eats
its own tail.
Yeah.
Dang, I should worry about it now, Cameron.
No, well, worry. It's a bit like the Seven West merger. It's going to
There's only
happen.
so much you can do, right?
Yeah, there's not much. Like it's also my perspective about the collapse of the Mag 7 or the potential collapse of the AI market. What Tony's taught me over the last 6 years from an investing perspective is we deal with reality when it happens. We don't prognosticate. We don't have a crystal ball. We just deal with it the best we can as it happens, right? So
Play the cards as they're dealt.
Yeah, prognostication is where the most fun conversations happen. But if we're talking about making money and we're talking about living our lives, you've got to deal with what's in front of you today.
Correct.
Yeah, that's all you can do.
Yeah.
Well, Michael, I think that's all we have for you. Thanks so much. Congratulations on the continued success of Collins Street Asset Management, and hope it's not 3 years before we get back on. We'll have to get you back on for another update in a year or so.
Cameron, Tony, always thrilled to hang out with you guys.
Thanks, Michael. Good to see you again.
Cheers, Michael.